Hi, good morning everyone, and thank you so much for being here today. My name is Weiren. I'm part of the research team at iFAST, and today the focus of my presentation is going to be on how investors should position their portfolios for the year ahead. And very specifically, I want to share with everyone two things in my presentation today. Number one, I'm going to tell you what are some of the markets and sectors that you should avoid in 2026. And number two, I will also tell you what are some of the things that you should be buying for your portfolios instead. Now, 2025 was, I would say, a very eventful year. We've had tariffs, we've had an escalating trade war between the US and China, we've had a steep market drop at the start of the year, and 2025 just looked like it was going to be a really bad year for investors. But surprisingly, as with the benefit of hindsight, we all now know that equities have delivered exceptional performance in 2025. And several markets across the world have in fact achieved record highs last year. And that includes markets like Japan, Europe, and even our home market, Singapore, managed to hit record highs as well. The US was also incredibly resilient. It was not a top performing market in 2025, but the US has recovered from the sell-off due to the Liberation Day tariffs, and it also ended the year near record highs. The US economy, everyone say it's going to go into a recession, right? But the US economy has also been far more resilient than what markets have expected. And the key reason that explains the resilience of the US economy and the stock market is because of AI. Companies have been spending a lot of money on data centers, semiconductor chips, software, and all these AI-related spending have contributed significantly to the US economy. And you also have the optimism that is surrounding the AI boom. And this has also led to the US stock market delivering pretty good returns in 2025. With the stock market doing well, consumers are also spending, because consumers in the US, they have made quite a lot of money on their stock investments. They feel richer, and what do rich people do? They spend. So this AI boom has been a key economic driver, and it also explains why, despite all the chaotic policy making by Donald Trump, why the US has not fallen into a recession, despite all that global uncertainty that has taken place throughout the year. But does that mean everything is doing well for the US economy? Not necessarily. Because if you take a closer look at the US economy, you can see that there is real pain within the economy. Now, I'll take a look at this slide over here, okay? Focus on the chart on the left. Now, this chart tells you the delinquency rates across various loan categories within the US. So very clearly, delinquencies are rising in the US. What this means is that people are increasingly falling behind on their loan repayments. And one particular loan category that I'd like to bring to your attention is auto loans, the red line in this particular chart. Okay? Auto loans are also starting to see a rise in delinquency rates. And why is this important? Why am I singling out auto loans to everyone's attention? It is important because car loans are typically the last payments that Americans are willing to miss. Why? Because cars are so important. It is the most popular mode of transport in the US. People need cars to get to work, they need cars to drive their families around, and they need cars to buy food. It is important to them. It is part of their lifestyle. So the fact that people are now starting to fall behind on their car loan repayments, this is a sign that there is real pain within the economy. At the moment, the ones that are under pressure are actually the lower income households. The higher income households, they are still doing relatively well. They're still spending for now, and that's also because the stock market has also been doing quite well throughout 2025. Now, that's where the risk is. Because if you take a look at the chart on the right, so this chart shows you the percentage of household net worth that is invested in the stock market. So this chart tells us that stock investments now accounts for about 30% of household net worth. This is the highest level since at least 1987. So consumers in the US, they are now more exposed to the stock market than ever before. So if the stock market continues to do well, okay, then I would say that consumers will continue to spend, everyone is happy. But what if there is a sell-off? If there is a sell-off, it will have a significant impact on consumption, given that households are now highly exposed to the stock market. And there are also other areas of weaknesses too. Okay? If you look at the chart on the left, this shows you consumer sentiment in the US, and it doesn't look good at all because consumer sentiment is near record low levels. Businesses, they are also not too optimistic because they have been laying off their employees because of weaker demand and also the uncertainty that is surrounding Trump's tariff policies. And even your big tech firms like Amazon and Meta, these companies have also been laying off their employees in order to cut costs and focus all of their spending on AI-related initiatives. So it is not that Donald Trump's policies had zero impact on the economy. Okay? Trump's policies has damaged the US economy. It is just that the impact is not very obvious because all that negative impact has been offset by this AI-related spending that has been helping to support the economy. So taken together, for the US economy, what we do expect is that growth will start to slow in 2026, but not to the extent that the US economy will sink into a recession because the AI-related spending is still going to be strong. It is still going to do a lot of the heavy lifting for the US economy. So this is essentially an economy that is split into two. On one hand, you have got all the AI-related, the tech-related sectors that are still expected to do well, that are still expected to be resilient in 2026. And on the other hand, you have got some of the other non-tech sectors that will be subjected to the economic slowdown, to pressures within the economy. So these sectors are unlikely to do as well. Same economy, but two different stories. And this also brings me to my first point. The first market that I think you should avoid in 2026 is the US equity market. Don't buy the US. Don't buy the S&P 500. Like I said just now, this economy is split into two. One that is expected to do well, the other not so much. So why buy the whole market when you could just focus your investments in the areas that are expected to do well? So for the US, we feel that a sector-based approach will be more effective. Instead of buying the S&P 500, why not buy into the internet sector? Because the internet sector will continue to benefit from rising AI adoption in the coming year, especially your big tech companies like Microsoft, Amazon, Alphabet. These companies are the backbone of the AI industry because AI firms, they all rely on their cloud infrastructure to train their AI models. And companies also depend heavily on these companies to deploy and sell their AI products. There is no AI without the big tech because of their wide consumer reach. And on top of that, these big tech companies, they also have diversified business models. They're market leaders in their respective sectors. And so this also provides some sort of a cushion from a potential slowdown in this coming year. Of course, if AI growth starts to slow down or maybe even starts to decline, it is entirely possible that companies like Microsoft, Amazon, Alphabet, they will start making less money on their AI investments. But they would at least not end up in financial distress. They will still have other business segments to rely on. And most importantly, they will still have plenty of customers even without AI. So instead of buying the entire US market, instead of buying the S&P 500, we think that a sector approach is more appropriate, and we recommend investors to invest in the internet sector instead. And if you're looking for a product recommendation, our recommendation to get exposure to the internet sector is the 𝐓𝐡𝐞 NASDAQ Internet ETF. Now, what about US Semiconductors? If you have been coming regularly for our FSM Expo, you probably have heard of us talking about this VanEck Semiconductor ETF. And I think you are probably sick and tired of us telling you to buy semiconductors almost every single year. But don't worry, this year I have a different message for you. Okay, I'm not going to tell you to buy the next US Semiconductor ETF. Okay, I'm going to tell you to take profit on this ETF. because we think that US Semiconductors is one area to avoid in 2026. And there are a few reasons for that. The first reason is valuations. Semiconductor stocks are not cheap at all. And when something is expensive, what it means is that investors have very high expectations in terms of earnings growth. So in order for semiconductor stocks to continue rallying in 2026, what needs to happen is that their earnings growth will have to exceed this very high level of expectations. So if they disappoint, then this could potentially be a trigger for a sharp pullback in their share prices. So semiconductor stocks right now, we believe that they are priced for perfection and there's very little room for error. On top of valuations, there are now also concerns over the sustainability of all this AI-related spending. So big tech companies, of course, they have lots of money on their balance sheets. But even big tech companies, they can't possibly spend this massive amounts of money forever without straining their balance sheets. And then you also have the model builders like OpenAI. OpenAI is also spending lots of money on AI-related initiatives. But look at OpenAI. They are loss-making. They are not expected to turn profitable anytime soon. And they currently don't have a clear path to profitability. How are they going to afford these massive amounts of AI chips that they have ordered from NVIDIA? So eventually, we think that there will be a reality check. There will be order cancellations along the way. And probably there will start to be earnings disappointment that could be a potential catalyst for share prices to eventually come down. So for those of you who have taken our advice to buy into the VanEck Semiconductor ETF, this is the time to start considering taking profits on your investment. And for those of you who have missed out entirely on this AI rally, and you're now thinking whether now's still a good time to go into US Semiconductors, my answer to that, no. But don't worry, because there's still something else that you can buy if you have missed out on this rally. So if you have missed out on this rally, you can buy Asian Semiconductors. Asian Semiconductors are the manufacturing backbone of the semiconductor supply chain. So everyone keeps talking about how the demand for AI chips is very, very strong. But what is less talked about is supply. Supply at this point is a real bottleneck because companies that are manufacturing all these AI chips, they have not been able to ramp up supply fast enough to accommodate this huge increase in demand. So companies like NVIDIA, AMD, they all outsource the manufacture of these AI chips to one company. That one company is TSMC. So these AI chip designers, they outsource all of their manufacturing, or rather virtually all of their manufacturing to TSMC. But the problem is that TSMC, it has been very conservative in expanding its supply. And the situation in the industry now is that there is a shortage of manufacturing capacity that has allowed TSMC to raise its prices. So customers like NVIDIA, AMD, they have no choice, but they have to pay a premium in order to secure their manufacturing capacity. And they have no choice but to rely on TSMC because TSMC has a near monopoly in advanced chip manufacturing. The same situation can also be seen in the memory market. Now, memory products are important to the AI revolution because they are essential components of AI chips. But there is also a shortage in the memory market right now because key players like Samsung, SK hynix, they too have also been ramping up their supply very slowly. And why are all these companies so conservative in ramping up their supply? Maybe it's an Asian thing. I think Asians in general, we tend to be a bit more conservative. But in the context of semiconductor manufacturing, I actually think it's prudent to be very disciplined in terms of your capacity expansion. Because expanding supply, the building of semiconductor plants, this is actually a very costly and a very slow process. So imagine if you are TSMC, you spend hundreds and billions of dollars to build all these semiconductor plants, only for the AI boom to die down in about 2 to 3 years' time. What is going to happen is you're going to be left with a lot of unused manufacturing capacity, and that's not going to be good. That's not going to be good for a business. So, taken So if you take a look at this situation where there is a disciplined approach to capacity expansion, I actually see that as a positive thing. Because if this AI boom dies down, this disciplined approach to supply expansion means that companies like TSMC, Samsung, SK Hynix, they will still have a sizable backlog, they will still have healthy earnings growth, even if there are order cancellations along the way. So this disciplined approach to their supply expansion, I see that as a positive thing. And the other key difference between US and Asian semiconductor companies is valuations. Even though they are all beneficiaries of the AI boom, the valuations of Asian semiconductor companies are a lot lower compared to US semiconductor companies. Take a look at TSMC. It's trading at around 22 times its forward earnings. And this is actually a lot lower compared to a lot of US semiconductor companies, despite its status as a monopoly in AI chip manufacturing. SK Hynix is also a lot cheaper compared to its US competitor, Micron, and that is despite the fact that SK Hynix has a larger market share and it is also a lot more profitable compared to Micron. Okay, and what this also means is that if you have lower valuations, this means that investor expectations for Asian semiconductor companies are a lot lower compared to US semiconductor companies, even though they are all beneficiaries of AI. Of course, if there's going to be an AI bust in 2026, the share prices of all semiconductor companies will come down, including Asian semiconductor companies. But because the starting point for Asian semiconductor companies is that their valuations are a lot cheaper, this means that their share prices will probably drop a lot less compared to the US semiconductor companies because of the much lower expectations that investors have subjected them to. So again, if you have missed out on this rally and you're looking for opportunities to ride the AI boom, there is still an opportunity for you. Buy Asian semiconductor companies. So how do you get exposure? I have a few ways, I have a few suggestions for you. One is, of course, to buy the individual stocks of the companies that I've just highlighted. Number two, you can buy the ETFs or funds that give you exposure to Taiwan and South Korean equities. And last but not least, if you just want one product to gain exposure to the to the Asian semiconductor industry, our recommended product is this Asia Semiconductor ETF by Global X, which is listed on the Hong Kong Stock Exchange. Now, outside of the US, we also have a couple of other markets that we are very positive on. So China is a market that we are positive on, and we do expect Chinese equities to continue their good performance in 2026. Now, just a couple of years back, I think the Chinese government was cracking down hard on its private sector. But fast forward to today, I think the government has since reversed its stance. And I think the government now recognizes the importance of the private sector to the economy. And especially now, because of rising geopolitical tensions, there is now an urgent need for China to achieve self-sufficiency in areas like technology. And the government recognizes that they can't do this without the help of the private sector. But so in terms of the policy environment, I think policy has largely turned supportive of Chinese companies. Of course, we all know that China's economy is facing some serious economic challenges. It is currently not doing very well. But what is less talked about China is that China is also in the midst of an AI boom, just like the US. Its AI spending is actually projected to reach about 98 billion in 2025. 98 billion, it pales in comparison to the roughly 300 to 400 billion that the US is spending right now. But nevertheless, this 98 billion places China as number 2 in the world in terms of AI spending, just behind the US. So there are still bright spots within China's economy, despite some of the challenges that they are facing right now. And on top of that, what really sets China apart from the rest of the world is innovation. So you may have read about this phenomenon that is taking place in China right now called involution or 内卷 in Chinese. So what this phenomenon means is that companies are engaging in unhealthy and excessive competition amongst themselves to the extent that their profitability and their margins have been negatively affected. So in the short term, I think this is, of course, a negative thing for Chinese companies because price wars are never a good thing. price wars have a real negative impact on the bottom line of companies. But if you take a longer-term view of China, this hyper-competitive environment that they are in is actually a good thing for innovation. Because this competition amongst them, it forces all the Chinese companies to always focus on cost efficiency. It forces them to always innovate. Otherwise, they will be driven out of business. So the ones that fail to survive, they will be driven out of business. But the successful ones that continue to operate, they will go on to export their low-cost innovation to the rest of the world. And this is something that we are seeing in the world right now. So many people will, of course, say, it's because of government subsidies, right? That's why they are able to sell their products so cheaply. Government subsidies is indeed one of the reasons, but it does not explain the full picture. When China wants to develop a new sector, there will be subsidies, of course, but at the same time, China will also relax the regulations. They will remove barriers to entries in order to encourage competition and innovation within the industry. So the people who cannot survive, the loss-making ones, they will go out of business. But the people who survive, they become national champions. And these national champions are now looking to make money overseas. One very good example that I'd like to bring up to illustrate this trend is BYD. Just a few years ago, I don't think there are many people outside of China who have even heard of this company in the first place. When you talk about EVs, the first name that comes to mind is usually Tesla. And for good reason, because Tesla has been the leader in the global EV market for many years. And even if you have heard of BYD, there is a very good chance you won't buy their cars. Because if you look at some of their earlier designs of their models, it is actually quite ugly. I wouldn't buy the earlier models of BYD cars. But the situation has clearly changed. Nowadays, for those of you who drive cars, do you realize that you now see a lot more BYD cars on the road? Yes, I see a lot of heads nodding because me too, I have been seeing a lot more BYD cars. And when I look at these BYD cars, I think to myself, wow, their designs are actually pretty good. This is something that I would actually buy for myself, if not for the high COE prices. Okay, so BYD has clearly been learning from their mistakes. They have been catching up fast, and the most important thing is that they have been increasing their market share in overseas markets. And I have this one chart here that shows you the annual EV sales comparison between Tesla and BYD. So the red bar is Tesla, blue bar BYD. So very clearly, BYD has been closing the gap with Tesla in recent years. And in 2025, Tesla is no longer the world's biggest seller of electric vehicles. It is BYD. BYD has successfully overtaken Tesla to become the #1 EV seller. Now, what do all these examples illustrate? This is my cue to not talk so much, okay? What do all these things illustrate? This tells us that China is no longer a follower in technology. China is more than capable of doing their own innovation. And what this means also for investors is that as these companies go global, as Chinese companies go global, they are going to make a lot more money than before. Because all these years, Chinese companies, they have very little market share. They have very strong market share in China, but very little penetration overseas. So as these Chinese companies go global, what investors are about to see is a huge increase in their profit potential of Chinese companies. So the long-term prospects of China is actually looking very good at this point. So if you're looking to get exposure to China, our product recommendation is actually the Lion Global China Growth Fund. And if you're looking for an ETF, we recommend the iShares Hang Seng Tech ETF. Now, I'm just going to skip over a couple of slides. Singapore is our top idea for 2026. We have a couple of speakers today. They're going to talk about Singapore. So I'll leave them to do the heavy lifting to pitch the idea of Singapore to you. But one thing that I'll just like to highlight for Singapore is that one of the reasons why we are positive is because of EQDP and some of the initiatives that are done by MAS in order to increase the attractiveness of Singapore's equity market. There is actually some early signs of success, and if they are successful, this could potentially be a structural tailwind for Singapore equities. Now, if you want to buy into the Singapore equity market, okay, the usual options they are suitable for you. The STI ETF, if you have a Singapore equity fund inside your portfolio, I think these options are still good enough for you to hold inside your portfolio. But if you would like exposure to the small to mid-cap sectors that are going to be the primary beneficiaries of EQDP, our recommendation is the Lion Global Singapore Trust Fund. I think they have a booth just right behind. If you would like to find out more about their strategy, please head to Lion Global's booth and find out more about what they have to offer. I think their fund manager is going to speak in one of the slots later. So go and find out about how they go about picking stocks within the small to mid-cap sector. Okay, so this is a summary of what I've shared today. Okay, don't buy US. If you must buy US, buy internet stocks. Avoid US semiconductors. If you have missed the AI rally, there is still time for you to get in by buying Asian semiconductors. Outside of the US, we are also very positive on China and Singapore. Okay, and with that, I end my presentation today. Thank you very much for your time.